Your 20s are the prime time to build wealth, but common mistakes can derail you. It's a decade of opportunity and exploration, a time when decisions can have long-term effects on your financial health. You might be fresh out of school, stepping into the world of work and earning your first paychecks. But with this newfound independence comes responsibility, especially when it comes to money. You see, your 20s are a golden period for investing, where time is on your side, and the magic of compound interest can turn small, regular investments into substantial sums. But it's also a time where missteps can cost you. From not having a clear investment plan to chasing quick, volatile profits, some pitfalls can seriously hinder your journey to financial success. So, what are these 7 mistakes you should avoid when investing in your 20s? Let's find out. Mistake number 1, having no investing plan. Picture this. You're setting off on a journey without a map or a destination in mind. That's what investing without a plan is like. It's easy to get lost, make misguided decisions, and end up nowhere near your financial goals. The consequences can be dire, ranging from lost capital to missed opportunities. Now let's talk about how to avoid this pitfall. First, define your financial goals. Are you saving for retirement, a down payment, or your child's college tuition? Knowing what you're aiming for is the first step. Next, determine your risk tolerance. Can you stomach the ups and downs of the stock market, or do you prefer a slow and steady approach? Finally, decide on your investment strategy. Will you be a passive investor, relying on index funds, or an active one, picking individual stocks? So remember, always have a plan before you invest. Mistake number 2, not taking enough calculated risk. It's easy to be conservative, to stick with what you know and avoid the unknown. But in investment, playing it too safe can be as detrimental as being overly reckless. There's a balance to be found. Calculated risk is the name of the game. You see, investing is about growth, and growth requires a certain amount of risk. It's about stepping out of your comfort zone, but not blindly. It's about making informed decisions that carry a certain degree of risk, but with the potential for greater reward. Think of it this way. You're on a tightrope. On one side is reckless gambling, on the other, overly cautious stagnation. Your goal should be to walk that line, balancing risk and reward. How? Research diversification and patience. Understand your investments, spread your money across different types of assets, and give them time to grow. So don't be afraid to take calculated risks when investing. Mistake number 3, chasing get-rich-quick schemes. Just as the name suggests, these are enticing strategies that promise you a fast track to wealth, often with minimal effort. They can be as straightforward as a lottery ticket or as complex as a high-risk investment strategy. Beware, though. They often result in financial losses and can even lead to ruin. These schemes usually rely on high-pressure sales tactics and unrealistic promises. They may also lack transparency, making it difficult to understand where your money is going and how it is supposed to grow. So, how can you avoid them? Educate yourself. Understand that genuine wealth accumulation takes time, patience, and consistent effort. Learn to identify the red flags, high pressure, lack of clarity, and too good to be true promises. And remember, if it sounds too good to be true, it probably is. Stay clear of get-rich-quick schemes and stick with your investment plan. And the worst mistake you can make in your 20s is not starting at all. Let's talk about the power of time and compound interest. Imagine a snowball rolling down a hill. As it rolls, it gathers more snow, becoming bigger and faster. That's how compound interest works. The money you invest earns interest, and then that interest earns interest, and on it goes. The more time you give it, the more it can grow, which is why starting early is so important. If you delay investing, you're essentially leaving money on the table. Let's say you start investing at 25 instead of 20. That's 5 years of potential growth you've missed out on, and those 5 years could make a significant difference in your financial future. So what's holding you back? Is it fear of the unknown? Lack of knowledge? Or perhaps you think you don't have enough money to start investing? The truth is, there's no minimum amount required to start investing. Many platforms even allow you to invest with just a few dollars. Yes, investing can seem intimidating, especially when you're just starting out. But remember, you don't have to be an expert to start investing. You just need to start. And the great news is, there are plenty of resources out there to help you. Start by educating yourself. Read books on investing, follow reputable financial blogs, or take a course. There's a wealth of information at your fingertips. Then, create a simple, diversified portfolio. Don't put all your eggs in one basket. Spread your investments across different asset classes. Set up automatic contributions. Even a small amount each month can add up over time. And remember, it's not about timing the market. It's about time in the market. The longer you're invested, the more potential your money has to grow. So don't wait. Take the first step. Even if you make mistakes along the way, that's okay. You'll learn and grow from them. The important thing is to start. So, the worst mistake you can make in your 20s is not starting to invest at all. So let's quickly recap the 7 mistakes to avoid when investing in your 20s. First, don't wander without a plan. Second, embrace calculated risk. Third, steer clear of get-rich-quick schemes. Fourth, keep emotions separate from your investments. Fifth, be watchful of high fees eroding your returns. Sixth, resist lifestyle inflation. And the most crucial of all, don't hesitate to start. Remember, it's not about being perfect. It's about starting and learning along the way. So what's next? Start investing now, even small amounts. The first step is often the hardest, but with the right resources, you'll be on your way. Consider trying out an investing app designed for beginners. There are also plenty of books that can guide you through the basics. Or you could visit a reputable financial website for tips and advice. Remember, the journey of 1,000 miles begins with a single step. So, start investing now and build your financial future.